Hi, welcome to this introductory video on equity joint ventures in commercial real estate. Thanks for watching. This introduction covers the early question, what is a commercial real estate joint venture? And secondly, introduces you to some common jargon and phrases that we need to know when we get into the business of looking for equity partners in commercial real estate investments. Now, this is the first in a series of videos on equity partnerships or joint ventures in commercial real estate. We're going to talk like an investor after this one. The next video is going to start looking at the cash flows. How do we distribute cash flows among multiple equity investors? And the final video is going to allow us to evaluate the returns to each class of investor in a joint venture. Before we start this topic, you need to have some baseline knowledge specifically about how cash flows work in commercial real estate investment if you buy the asset directly as the sole equity investor. That's been the focus of the course today. So we need to know direct property investment cash flows. That's what we often call our unleveraged cash flows. But we need to know how those are distributed among us as the sole equity investor and our debt or our lenders or our debt investors. We need to know how direct commercial real estate is taxed and how we can think strategically about adding value and increasing returns if we are a direct real estate investor. So a lot of those skills are going to apply when we're managing a joint venture. Where we're going is equity investment. How do I further design my capital stack to include additional investors that are going to invest outside equity in my commercial real estate investment, so we can start answering a really fun question. Real estate's expensive, right? So how could you buy $1 million worth of commercial real estate investment property with just 15 grand or even less, possibly? That's where a real estate investment structure comes in. We're going to design capital stacks so that you can as the real estate experts, sit at the top and manage a joint venture of equity investors along with lenders and debt investors. We're going to have more than one source of equity. It's not going to just be the money in our pocket and debt. It's going to be multiple equity investors and ourselves. Now, what's the problem that a joint venture is solving? Well, think about a market like this. All of us watching this video are training to be experts in the real estate investment markets. We have some excellent expertise, as I just mentioned a couple slides back, of how commercial real estate investment works and strategies on adding value and extracting the highest returns out of that investment. Now, there are a lot of investors that read the financial literature, and a lot of that literature says real estate is really good addition to a general investment portfolio. But they're not real estate experts. They have money, they'd like exposure to real estate investments, but they're not experts. So they could give their money to banks who would lend it out and be your debt investor, or they see a way to increase their return on capital and invest it directly with you as an equity investor, because there's a key thing about debt investment. You never pay your lender more than that lender is owed. So debt investment is low risk, but also low returns. Many investors might want exposure to equity and a share and a slice in the pie in excess returns if we happen to be so good at our real estate investment skills that we make more money than we expect. So we have two things on offer here. We have a real estate expert, all of us, and we have a group of investors without expertise, but with a lot of money that they would like exposure. So we can put those two together. We're going to call it a joint venture between those two parties. That joint venture will form an entity or a company, investment vehicle, to own real estate and invest in it for income and capital returns. So that's the trade here. What are the benefits? Well, we can share risk. I don't need to put all of my investments in one specific direct real estate investment. I can, if I have a lot of capital, I can distribute that among many projects and therefore hedge any risk that a single project doesn't come to fruition, right? And that allows for real estate portfolio diversification. There are real estate investors that would like exposure to commercial real estate risk, so they want to share in the risk as well. So we're going to combine our expertise with their capital looking for a home. I'm going to go further into this here. Remember from our lectures about debt, that debt lenders have specific underwriting practices that make the acquisition of loans unobtainable in some scenarios, specifically if the project is really, really risky or doesn't have income for quite a while. So a joint venture will facilitate speculation in the event that debt may not be obtainable. And this is also the case in big recessions. So after the financial crisis in 2008 and 2009, credit markets froze, but real estate investment still occurred, albeit on a smaller scale, through joint ventures where investors found 100% of the equity among themselves and their outside investors. And this is probably also likely to be the case if the coronavirus pandemic here in 2020 goes on for a long time and lenders start worrying about their own balance sheets as opposed to new lending. And like I promised, we can get in the game now with a lot less capital than you would need to buy directly. Now, what are the risks of a joint venture? Well, if you're an outside investor in a joint venture, so you're providing just capital but no expertise, well, you're completely unsecured. If the investment doesn't work and you don't receive the returns you were promised in the joint venture contract or agreement, well, you don't have the right to foreclose like the lender does. So you're out of luck. You might lose all of your money. The sponsor, which is the jargon term for you, the real estate expert, will have legal liability for the project. And we'll talk about that in a second. Another risk is that you're in a competitive market for capital. So although you would like to provide 8% returns because on the pro forma it makes your potential upside risk or upside returns from this project good if you can get the capital market to accept 8%, it's a competitive market. Other competitors might be offering 9, 10 for projects that have similar risk profiles. So you have to compete for that capital in an open market without clear underwriting guidelines like loan-to-value ratios or debt service coverage ratios. So there's a lot of marketing expertise and selling the deal that goes into a joint venture. And the better you are at that, the better you might have, better luck you might have at securing investors that demand lower returns, which leaves more for you as the sponsor. And finally, your outside investors are not experts in real estate, but they might think that they're experts in real estate and want to either help you manage it or control it, or they might decide, hey, I want to liquidate my asset, and you might say, well, sorry, we're not liquidating this fund until our investment strategy is complete. So you will have to manage those investors' expectations throughout the joint venture. So one of the first decisions in a joint venture is, how do I organize the entity that will be doing the investment? Now, when we were looking at direct real estate, we were always assuming that the investor was a sole proprietor, so they have individual ownership of the investment stake. But now we're getting multiple parties involved and an equity agreement, so we can classify that as a partnership, we can have limited liability companies, or we can be organized as a corporation. In yellow, I've highlighted the two key organizations that most real estate investments take. Most joint ventures are partnerships, with the general partner being the sponsor and the limited partners being our outside investors. But really big investments with huge portfolios are often organized as corporations, and if they own enough real estate and their business model is in the investment of real estate, then they can qualify for special tax benefits as real estate investment trusts. So the reason that these structures exist is the investment entity wants to avoid double taxation. And we don't want to be taxed when the entity itself is taxed, and so therefore what we have to distribute is equity after tax cash flows. And then remember, the distributions that go to the outside investors and us as the sponsor would then be taxed as income to our own personal accounts. So why partnerships and real estate investment trusts, those investment structures allow the investors to pass through the earnings from the commercial real estate investment before it is taxed at the entity level. So to put that in a balance sheet perspective, that allows the investors to distribute the equity before tax cash flows from an entity perspective, and then the tax is paid by each individual investor's tax situation. So that avoids this issue of double taxation. So a key thing when you start a joint venture is you have to sign a document or an agreement between yourself, the sponsor, and the outside investors on how the joint venture is to work, how the individual contributions are distributed, if there's additional capital contributions in the life of the investment. So remember, you make an initial investment, but often maybe there'll be some capex in year 3, or the market goes south and vacancy costs or collection losses increase in year 5, and you need more equity to avoid foreclosure or other kinds of defaults. Well, you need more money. So that's called a capital call if you need to raise money in the middle of a joint venture agreement. Those are generally bad. Whenever you as the investor have to make a capital call, it's generally because something went horribly wrong. Now, a lot of joint ventures plan on value add, spec, or other highly risky real estate investment ventures, as I mentioned earlier. What is normally the case is that those investors will raise all the money they need throughout, or they expect to need throughout the course of the investment upfront, so that they do not need to make a capital call unless things again go wrong. We're going to look at priorities. So these agreements specify how cash flow priorities in both income and sale flow to the different classes of investor, our preferred investors or our outside investors and our sponsor. They'll be promised a percent return. That's called the pref. We're going to talk about jargon in a second. And how do we allocate income and losses for tax purposes? How do we pass those through? You can pass through depreciation allowances from the assets you own. And then we want the sponsor to be motivated to do the best job he or she can. So that's called a promote. And we have to agree who controls things, who can make decisions on the management of the property. In these last couple minutes, I want to go over key jargon that you need to know for the rest of the videos in this section. We need to know outside investors. They're also called limited partners, or sometimes even the money. These are the partners in a joint venture that contribute capital but not expertise. The sponsor, or the general partner, and remember general partner and limited partner refer to their legal liability in the partnership that they form. So they're only called partners if they're in a partnership. The sponsor is the expert that contributes their expertise and a little bit of capital to ensure that their interests are aligned. Now, when we distribute earnings from the property to these equity investors, there's important terms to know. First is pari passu, or equal share. This is where we distribute the money percentage-wise based on how much of the equity each individual investor invested in. So if I own 10% of the equity, I would receive 10% of the earnings in a pari passu scenario. Second is our preferred return, but I kind of want you to get to know the word pref because that is what's used in the industry. The pref is a promised return on the investment. Now, notice big capital letters at the bottom. The practice is on, does the outside investors get paid in full before the sponsor receives any money? Are they paid at the same time, pari passu, until the pref is reached? Those can vary between contracts, so it's really important to understand how the money is distributed, how the pref is paid in the contract. And finally, we need to know what happens with excess returns. So once I pay off the pref, my equity investors have been paid what they're promised, there might be money left over. One benefit of being an equity investor as opposed to a lender is that you share in that. So the waterfall is the agreement of how to distribute excess profits. And finally, the promote is an incentive or an increase in pari passu returns that the sponsor receives of excess returns. So this is how the sponsor makes tons of money when the waterfalls are running. Thanks for watching.